Hi, I'm Pattu from FreeFinCal, and in this video, let's compare a lump sum investment with SIP investment and find out that SIPs do not reduce risk as many people missell it, and SIPs do not help you get higher return or increase returns. So, we're going to take ICICI Focus Blue Chip as an example fund, and we're going to start an SIP on April 3rd, 2006, and it's going to continue all the while. And on that day, on April 3rd, 2006, we're going to do a lump sum and make no further investment. So that's the lump sum investment, and then there's an SIP, and we're going to compare the two. Of course, this is not a practical investment strategy. I'm not going to discuss an investment strategy here. What I'm trying to do is to show you that SIPs do not help you get higher returns, or they do not help you manage risk better when you compare it to a lump sum investment. That is the purpose of this this study, and you have to take this in the right context. Of course, some of you won't, but well, that's life. So this is the on this you're seeing the value of the investment moving from April. Well, it's not from April 3rd, 2006, a little bit later on. So that's how it was 1,000 rupees, and then it moved up, and then this is the SIP that's moving up. Can you see the movements in the lump sum and then in the SIP? Initially, there's a big difference, but then they kind of catch up, and you can see that both of them react equally to the market ups and downs, right? And this essentially means after some time, the risk associated with an SIP investment is pretty much the same as the lump sum. I'll show you much better data than this, but this just gives you a visual idea that there is some similarity to be expected. And what you see here is every dot is the return 1 month later. So this is like after you start the investment, this is the first time when you can actually calculate a return. Like you started it in April 3rd, 2006. So I've calculated the first return after 3 years, a good 3 years later. And then again for the lump sum, I've calculated, the blue is the SIP, the SIP is the return XIRR is here, the lump sum is here. Notice that with the passage of time, the difference between the XIRR, the SIP XIRR and the lump sum XIRR vanishes, and they pretty much move up and down in the same way. Initially, of course, this difference in the SIP XIRR is natural, because what happens is that you make the investment every month in an SIP. So there are many installments at different age. Some installments are older than 1 year, some installments are just a few months old, some installments just 1 month old, and because of that there will be a difference in the XIRR due to the way in which it's calculated. I have a video on how the XIRR is calculated. You can look at that to understand why there's a big difference. Whereas in the lump sum there's just one investment, and then you leave it, and then you move on to it. So that's the reason why I keep saying SIPs don't help you in any way to achieve higher returns. Because you start an SIP because you get money every month because of a salary, and then you kind of automate it. There's nothing systematic about an SIP. It's an automated investing. In a lump sum, you invest once and you just leave it. But what happens, the reason why the lump sum return and the SIP return is the same, and also if you the risk also will be pretty similar, I'll show you that, is because it's like you have a big bucket and you're pouring water into a bucket using a small mug, right? That's your SIP installments. You're basically pouring mug after mug on the same day every month. The water in the bucket is filling, but you're not doing anything to the water in the bucket. All you're doing is pouring water into the bucket. The bucket itself is getting filled up, and it's feeling the full heat of the market. If the market crashes, the bucket will slip and fall, and the water will pour out. Your investing every month will not help you manage that risk. And what happens is, after some time, the amount in the bucket will be higher than the amount you put in every month because of the growth of the investment. And therefore, the risk associated with the water in the bucket is much higher naturally. So this is the return difference, and this is the difference between the SIP return and the lump sum XIRR difference. Notice that initially the difference is high, and then it quickly drops off to 0, and then it's kind of pretty much around 0. A little bit difference here and there, but you can't say which is better and which is there, which is less better from this and so on. Let's not push the analogies, but essentially it's around 0%. It's insignificant, the difference between the lump sum and the SIP difference. Now, this is the monthly fluctuations in the returns, the monthly returns or the monthly variations in the portfolio value. Notice that initially again there's a small difference, don't worry about that, but after that it's pretty much identical. So if you calculate the volatility in this period, the volatility or the standard deviation of the monthly returns, they'll be identical. There's now no difference. Where is the risk reduction due to an SIP? Nothing. The SIPs do not reduce risk compared to a lump sum. These mutual fund guys say that because they want commissions regularly. That is the only reason they say it. Oh, please. The other thing is, don't do an STP. There's no great benefit in doing an STP because again, STP is like an SIP. It does not reduce risk. It does not help you get higher returns because I've shown that in a much better study in another video. The only reason mutual fund companies and sales guys want that STP signed off is because they'll take your money and put it in your liquid fund or an arbitrage fund. That's it. The business is sealed. Then it will automatically go into the equity fund. So they are happy because their job is done. There's no great benefit out of it. You can do it. I'm not saying you cannot do. You should not do it. You can do it, but don't do it because there is a benefit. There is none. That's my point. Because after a few years, it all evens out. Everything will look the same because the amount in the SIP value becomes so high that the risk, the fluctuations in that is much higher than, and there's no real benefit of buying more units when the market falls and higher unit as the market moves up. More units in the market falls and less units in the market moves up and so on. There's no real benefit of all that. So please don't assume that there's some great benefit out of an SIP. People do an SIP simply because the money comes in every month and you just put it in. And there's no need to do an SIP. I would rather suggest that you become disciplined, actually become disciplined and do it on your own. It takes 45 seconds to do or under a minute you can do an SIP. You can buy units every month on your own. It's no big deal. Don't get wrong ideas because people, everybody's out to get a profit. Please don't get misguided. I'll catch you again in another video. Bye bye.